Alright guys, welcome to this video. We are going to walk through how to perfectly execute a buy order using the pattern, the double bottom pattern. So we are going to start off from the beginning of the day as we look at the candles that form in the Asian session. So in the chart you can see there are arrows labeled A, B and C, and what is common in these arrows is the fact that the candle sizes are very small, regardless of the direction at which these arrows are pointing. So in arrow A, the direction is going up. That is to basically accumulate orders in the upside or buy orders, and then it is followed by the B arrow, which is accumulating orders down, and at C it is accumulating orders in both directions. But what is common is that these candles are very small. The market has not actually made a very significant move. The candle size is there, not convincing enough or significant enough for us to conclude that there has been an aggressive move in the market. So all these these candles, we consider them to be the consolidation candles, the accumulation phase of the market. There is no big move yet in the market, so we disregard all these moves, the up and down. We disregard them and we look to find an aggressive move in the market. So to the right side you can see the explanations about what is considered the consolidation zone, and in this instance we are basically looking at the objective of the market, which is basically to get traders to take a position. It is in just inducing or accumulating orders. So we now move on to the next section, where we are going to identify or look for the big candles that are going to really cause a movement in the market. So at this point you can see the arrow that is stretching from the section C all the way up in those three big candles. Let's just say two big candles. There's just one small candle, but it is labeled D. These candles are significantly big compared to all the candles from A to C. So now you can see that momentum is coming into the market. We can now see aggressive moves into the market, and this move, it is called a breakout of the consolidation zone. It is described the breakout of the consolidation zone. What it is trying to do is to induce traders with those big moves, trying to get them to take long positions. But the point is, it is all going to be fake. At this point there is no commitment or sustainability in these moves. There is little volume that is been accumulated in the market, so the market is just working with their own resources to try to push or create some form of aggressive move in the market. So what we want to see is the actual move that is going to be the actual move that is going to determine the trend for the day, where the price is actually going to be going for the rest of the day. So at this point we expect that price will retrace or not sustain this move that has been made, where this phase is called a retrace of the breakout. So you can see with the red candles that are coming back down, labeled E, pointing with the arrow labeled E, those candles are showing an aggressive move to retrace or to cancel or not to sustain the big move that has just been made in D. So like I said, the market doesn't have volume as of yet, the volume to actually sustain or to actually continue in one particular direction. So the market is basically inducing traders to take long positions or short positions. So in this case, the market is now sort of like retraced against those guys who took long positions by the inducement that was done with the green candles in D. So now what we now expect is to observe an inducement again in the opposite direction, what we sometimes call rapid moves, 3 rapid moves in the opposite direction to the downside. So you can see with the arrow labeled F, there is a one big long candle. It's a red candle that is going all the way down to form the lowest or the lowest price of the day as of this point. This move is a very aggressive move, and it has created panic, has made investors to believe that the market is going down, and have caused them to place their sell orders during the formation of this candle. So most traders have placed their sell positions because of this long candle. Now the period at which price had induced traders to take long, that is a D, most traders who place their buy orders who usually place their stop losses below the arrow C, and these stop losses, most of those stop losses, even if not all, have been taken out by the candle F. So this move is also sometimes called the stop hand move, but for our purposes, this is the point that we now start to draw out our double bottom or our W pattern, our signal for us to take a buy order. So there is confusion in the market. People are placing sell orders. Some are have placed buy orders, but what we do know is the fact that this is now an outside structure or formation of the first leg of our W, and we are still waiting for this pattern of the W to complete so that we can take our buy order. Now the arrow is showing that price is risen up. With the G, the price is risen up all the way back and even touching that blue line right at the top, almost close to the arrow E. So that shows that the market is basically made very aggressive moves to hit the stops in both direction, or induce traders to take long positions or short positions. Either way, traders have been induced or have been made to believe that the market is in a state of confusion. So in our context, we see this as the formation of the first leg. This is now where the first leg of the W is formed by following the arrows E, F, and G. We can see that it has made a down and up move, a downward and up move. So that is called the first leg of the W, or the first leg of the double bottom. So what we want to see or to confirm our signal is called a retest, or the second leg, the formation of the second leg of the W, which I will observe with with the price coming down to retest the lowest price of the day. Right, so as you can see with H now points down, price is now come down to retest the low of the day, and you can even see the movements that have been made there. That price is basically dropped all the way from that point it had reached in G all the way down to almost reach the point that the arrow F had actually reached the lowest price of the day. So this is what we call the W formation, or the double bottom formation. So at this point, this is the safest point where we can place our buy orders. So as you can see from those orders that have been placed there, the first orders were placed right after, as soon after that candle formed the F candle, the big candle. As soon as it had made its aggressive move to the downside, the size of that candle was 50 pips. So we basically used that size to determine the range at which that candle was going to stop at, and we just executed a buy order right at the tip of that candle. So hence you can see those two orders that are showing there at the right at the bottom there. So that's where we basically see the execution of our signal, our entry based on our signal, the W formation. So in the next picture, you can see that it is marked the accurate entry, or the confirmed entry, is soon after that H candle had closed, and you can see it is followed by a green candle that was pointing down or painting red at some point, but immediately just rose to continue in the uptrend. So you can see all those candles, they are now going up all the way for the rest of the day. So this is what we mean by the signal to execute our buy order, as we expect our projection to go against the inducement, or the panic, or the belief that was created that the market is actually going down. So you can see with the markups right there, starting from this section, the consolidation section, we can see that a fake line, or a fake support line, was created as buyers, most of them were induced to take on long positions on that ROC, but they were retraced with that ROD, and then you can see the numbers 1, 2, and 3, which indicate the 3 rapid moves to the downside to try to induce shorts, and at the same time also hit the stops, what is called a stop hand. So at that right there, you can see a W. It is pointing to that section where we have reached F. We come back to G and repeat the low with H, and then after H we execute our buy orders. So you can see in this picture, the full image shows that we executed our first orders at the bottom, our second order immediately when the candle was painting green, and that candle was moving very fast, so it took time to actually execute it at the point that we actually wanted it to be placed. But nevertheless, the trend is going to be resilient. It is always going to continue rising, and we believe that it is safe to even place your order without worrying about your stop losses. So at this point, you can see the pullbacks that were created, but every pullback at this point, we also managed to place more buy orders. So this is what we say is the perfect double bottom, or the perfect signal for a W pattern. All right, that's all for now. Thank you for watching the video. Don't forget to like and subscribe.